We have a great guest this morning. We have Nel Stubbs from Conklin deDecker. But before I go into her presentation, I want to play a little one of our videos for you. So take a few minutes and listen to my great words. Some people have asked me, how does sales tax law get put in place? So I'm going to explain it to you. Here's exactly how it works. And we're talking about California sales tax law. The legislature decides that they want to pick a specific topic and make it subject to sales tax. So they debate it and they run it through committees and they do the standard thing and they write a law and they vote on it. Step one. Step two is they give that law to the state of California's taxing authorities to create what is known as a regulation. Okay, so then the people who have a vested interest in collecting the tax take their interpretation of what the intent of the legislature was and creates what known as regulations. You see, have you ever played that game where you sit in a circle at a party and you whisper a sentence and by the time it gets to the end it bears no relationship? So what do you think is the chance that the taxing authority absolutely duplicated the intent of the legislature? Pretty much zero, right? Well, that's not the end of it. It gets a little bit worse. Now the state of California, having written this regulation, has a problem. They have to create training manuals to teach people how to do that. So they turn it over to probably an HR department person or a group, and they create the training manuals. So now it goes from the intent of the legislature, it's rewritten to a regulation, so there's a little bit of a degrade of the intent, and then it's written into a policy to train people, to explain to people how to do it, okay? So it goes from the intent of the legislature down to the regulation, now down to the policies. So you can see that you're having problems dealing with taxing authorities. But that's not the end of it. Have you ever worked in a company, a large company, that had big training forces and training manuals? What do you know? 5 people holding the same kind of jobs are given the same training manuals, sent to the same training classes. Do they all work exactly the same? Of course not. All right? They're human beings. Limited experience, their inability to duplicate written information, whatever it is. So when you have 5 people, they're doing it 5 different ways. So if there's ever a question in your mind, how can an organization as big as the state of California, why isn't there consistent enforcement of these things? Because of what we've just talked about. A law is created by this legislature and they have a very specific intent. Then it's turned over to the state of California. It used to be called the Board of Equalization. It's now called the CDTFA, California Department of Taxes and Fees Administration. Law is given to the CDTFA, they write the regulation. Now the HR department of the CDTFA has to create the policies and the procedures so that they can teach people how to enforce that regulation. What you've got is the intent of the legislature being rewritten by the taxing department, then again that being rewritten by the HR department, and then being interpreted by whoever is assuming the training. So there's a 4-step degrade that happens on everything. Everything. That is why the enforcement is inconsistent. So if you're ever having a problem, whether it's property taxes or IRS taxes, that stepped process will probably explain it to you. I'm Tom Alston. I'm here to help you. Okay, here we are. We are back. Are you ready to go?
Can you hear me?
I can hear you fine. I can hear you great.
Okay. I'm not going to be able to hear you, only myself. Thank you, Tom, for this opportunity. I really appreciate the opportunity. A few of you have known me maybe for a while. Hi, Dave Marshall, Lee Road. Good to see you. Conklin and deDecker, just a brief one, was purchased by JSSI the 1st of April, and that's why you see Conklin and deDecker, a JSSI company. Doesn't change anything for me. I'm still doing what I've always done. And for today, I'm going to be covering state tax considerations for the seller and the buyer. Tom and I have worked together for a number of years. He is the go-to person for me and a lot of people for California taxes. I have the pleasure of doing the other 49. So thank you. Now where do I go to advance my slide? Next. We're good? Okay. So when we start looking at taxes, some of the things that are always fun is people say, well, where should I take delivery of my aircraft? Where should I hangar my airplane? Oh, I took delivery in Oregon, and now I don't owe any taxes. And I said, well, that's great. So I took a presentation that I've been doing for a number of years and broke it down into what the seller should be concerned with and what the buyer should be concerned with at the state tax level. As we all know, the application of state taxes can be often confusing because there's lack of uniformity among the states. They're not the same. We got 50 kingdoms out there, not 50 United States when it comes to state taxes. Aircraft are flown into multiple states, so you have their exposure in multiple states. Misconceptions on how these taxes apply, whether it's a sales tax, a use tax, a property tax, a registration fee. It's misconceptions about how the taxes apply. Legislature. There is activity within the state legislatures every single year that change or modify these taxes, raise the tax, change an exemption, take away an exemption. We have a lot of that going on, and it's just plain old bad information. One cautionary note is that if you're reading an article on the internet, please check the date of the article. A state tax article written in 2002 shouldn't be on the internet anymore because it's not correct. We also have the states paying a lot of attention to general aviation and business aircraft. The airlines, they're pretty simple, but GA coming in and out, they're paying a lot of attention to our business aircraft. The taxes that we are looking at are things like gross receipts tax. Some states have gross receipts tax. Some states have transaction privilege taxes. That would be Arizona. Use taxes, aircraft registration fees, personal property ad valorem taxes, fuel taxes. We also have taxes by another name, license taxes, operating fees, and excise taxes. One of my favorite stories has to do with New Hampshire, and I've been researching state taxes since 1988. And I was getting this information from the state aviation directors, and they were very good in sending information. And I would send a request to New Hampshire, and he would tell me about a low, like no sales tax, and they had a low registration fee. And this went on for years and years and years. And then I get a call, and somebody says, "You're not covering operating fees in New Hampshire." And I go back to my contact in New Hampshire, and he says, "You didn't ask. That's why we weren't telling you about it. I didn't think you wanted to know." So now I just go, are there any other taxes that apply to aircraft? So we want to make sure every single tax. So what state taxes is the seller concerned with? Basically, they're only concerned with the sales tax. What the seller does not want to do is to have to collect or remit a sales tax in any state, because if that's the case, then they could trigger the doing business in the state tax. So then we've got an income tax issue. So the seller is usually wanting to make sure that they're going to deliver in a state where they can avoid having to collect the sales tax on the acquisition of an aircraft. So number one, they're going to look for a tax-free state. The next thing they're going to look for are states that just do not tax airplanes or helicopter sales, and helicopters are different. The next is a state that has a Flyway Rule or an exemption. And other, I kind of throw my North Carolina and South Carolina into that other. So our tax-free states, they've been the same as long as I can remember. We've got Alaska, Montana, New Hampshire, and Oregon. They just do not have a sales or use tax. States that don't tax airplane or helicopters: Connecticut, Massachusetts, Rhode Island, Maine, Delaware, New York, and Pennsylvania for helicopters only. They're all up in the New England area. We need to get some of those exemptions down here in the Southwest. But these are states that just do not tax aircraft sales. The Flyway Rule, and this is basically if you remove the aircraft from the state within a certain period of time, then no tax is due to that state on the sale of aircraft. And when we say a particular period of time, we're looking at, it could be, the first use must be to remove it from the state, which would be Arizona and Texas. That's what the rules are there. Then we have states that say if you remove it within 3 days, 10 days, 15 days, 30 days, and in the case of Colorado, 120 days. Some states will say if it goes right into maintenance, you might have a problem because they still want it out of the state within those 10 days, but a lot of states have made changes to their rules, including Colorado. So states with the Flyway Rule, my big thing is forms. If you're going to use an exemption, such as a flyaway exemption in a state, make sure you use the state-provided form. And if they don't have a state-provided form, for example, Colorado, create one. Kind of like when you're buying a car from a casual sale. You're buying a car from a person for $1,000. You still gave them a little piece of paper that said you bought the aircraft or the car, and they gave you a piece of paper saying you bought the car. So you want to make sure that you have something in hand that you are doing good faith and not blind faith. Other exemptions would be the occasional sale exemption. I'm not a huge fan of occasional sale exemption. They're very, very narrow, very, very strict, and very often are not valid on aircraft sales. So use of occasional sale, you really need to make sure you read everything you can and the fine print, and then call somebody and make sure that you read it correctly, because I'm not trusting occasional sales on multi-million-dollar assets. Common carrier exemption, usually the seller would prefer not to use the common carrier exemption as the exemption, because, by the way, if you're buying an airplane, it's usually not on the common carrier's certificate until a couple of weeks at a minimum after you purchase the aircraft. So those are those. So then, here's the buyer. So now that the buyer has voided the sales tax, they usually say, I'm good. You get a lot of people going, well, I took delivery in South Carolina and I paid the $500. I took delivery in New York. I didn't have to pay the tax. I took delivery in Arizona and I first used after it came out of maintenance. I removed it from the state. Great. Where are you going to hangar that aircraft? Okay, everybody knows the answer there because, oh, it's an aircraft. It flies all over the place. It's used in multiple states. Great. Where are you going to have it maintained? Where do the pilots go at the end of the day? Where does it primarily based? Where does it spend the most time? That's the state you want to focus on. And sometimes we have buyers that can actually pick one of two states, and we'll sit there and look at both states and see which one is the better tax state for them on the aircraft. But by the same token, it may not be the best tax state for income taxes. So you've got to be careful that you balance all the taxes. When you're owning the aircraft, you're now going to look at sales tax, use tax, personal property taxes, aircraft registration fees, and a whole slew of other taxes, state taxes come into play here as well. So sales tax, same as the seller. They're going to take delivery in the state. Usually the buyer, I'm one of those buyers. I prefer to buy my car in Prescott and pay my taxes in Prescott. So I'm going to prefer to take delivery in a state where I don't pay taxes in that state and then bring it into my state and pay my taxes here. So now that they've avoided the sales tax, we have the purchaser, the buyer, the owner now has to deal with the use tax. Every state with a sales tax, gross receipts tax, a transactions privilege tax, excise tax has a use tax. The use tax is a backstop to the sales tax and is imposed by the state to compensate the state for sales tax lost for assets purchased outside the state. Anybody from the East Coast? A lot of people would go into Delaware to buy a car. As soon as you brought it into Virginia, you had to pay tax in Virginia. They focused on the car. They even got to the point they were looking at refrigerators. So you owe the tax where you're actually going to take the asset. Shay, don't get mad at me. I know I'm using the cursor. Use tax, it's usually the same rate as the sales tax. I have to say usually because there's always a state that gets a little tricky and makes it a little bit different. More than one state can impose a use tax. So more than one state can impose a use tax. It depends on what their nexus requirements are. You also can use a credit for taxes paid to another state. So if you paid tax to another state, you took delivery in South Carolina, you paid the whole $500 there, they'll give you credit for that $500. But this is where it gets exciting. This is where the trouble begins, but it's also where the excitement begins. So as I've already said, the application of the use tax is generally based, and usually is based, aircraft is based, domiciled, maintained, the owner does business, the owner is a resident. Where does the aircraft go at the end of a trip? Where does it go on a frequent basis? One short story, a client that he lived in Louisiana, and the aircraft went home after every trip to San Antonio, Texas. The state of Texas, and this is years ago, this is my goodness, let's just say 12, 15 years ago. And the state came after him and owed tax on that aircraft because it was domiciled in Texas. So they kept on making the argument, they called me in, made the argument, well, no, the aircraft is registered in Louisiana, da-da-da-da-da-da. But the pilots brought it home after every trip, the completion of every trip, they brought it back to San Antonio. Well, at the end of the game, and there's a whole lot of other stuff going on, anybody ever want more detail, I'd be more than happy to help to go through it. But they did determine that the aircraft was hangared in Texas, but they allowed them to pay tax on the lease payments they'd been paying rather than assessing the tax on the full purchase price of the aircraft. So that was one where I got to go before the comptroller's office. That was exciting. I've never been told that I didn't have to answer that question. That was nice. So ways to minimize your use tax, looking at exemptions and exceptions. We can look at the occasional sale. You know my position on that one. I don't care for it. Trade-in exemption. But usually the trade-in has to occur in the state. So the actual acquisition of the aircraft would have to occur, and the selling and the acquisition would have to occur in the same state. You also have the dealer or lessor exemption. That's also called the resale exemption, that you're purchasing it for resale as opposed to purchasing it in the business. Common carrier exemption. The Flyway exemption does not work on use tax. Trade-in exemption sometimes doesn't work on use tax. And the occasional sale exemption, again, I will just leave it at that. The dealer, when I'm talking about the dealer lessor, you need to be careful. Some states will have a dealer exemption where you actually are purchasing it to hold it in inventory, but you cannot, the lease of the aircraft triggers the tax on the full purchase price of the aircraft. This would be the case of our good state in Iowa. They only have a dealer exemption. Illinois only has a dealer exemption. They do not have a lessor exemption, meaning you cannot set up that cute little LLC to buy the aircraft for resale. If you're going to do that, to buy an aircraft for resale, please make sure you get that seller's tax ID number before you buy that aircraft, or at least get it before you bring the aircraft into the state. This backwards tax planning is very good for Tom and I, but it's not good for you because you have to pay us to get you out of trouble. So in our case, we actually at one point had to pay Tom to get us out of trouble. So, so make sure you get that, if you're going to do a dealer lessor exemption, make sure you get that tax ID number, make sure you have a lease agreement, make sure you have a fair market lease payment, or else the state will come back in and call it a sham. That's what we work with. The common carrier exemption, you got to be real careful with common carrier exemption. California has a very unique common carrier exemption, in fact that you only have to have the aircraft on the 135 certificate in the first year, used greater than 50% in 135, and $50,000 in revenue from third-party charters must be made in that first year of ownership. After that, you can take it off the certificate until such time you sell it. But if you take it off certificate, you're not going to get the 130, the common carrier exemption on parts and labor in California. So you always have to look at that. But Arizona has a new common carrier exemption. It's a 50% rule. A lot of states have 50% rules. Most states have a 50% rule. Oklahoma just put in effect a 50% rule, but it must be used more than 50% for third-party charters. So related party charters do not count towards their 50% rule. So if there's a common carrier exemption, look at what drill down, look at what the rest of the story is on the common carrier. Aircraft registration fees. This is typically an annual fee. It can be based on a lot of factors, including the age of the aircraft, the weight of the aircraft, number of engines, the type meaning is it a jet, a turboprop, a piston, is it multi-engine, single engine, is it a balloon, is it a piston? So we're looking at the registration fee, we'll look at all those types of factors. Generally requires a presence in the state. So that's the 30, 60, 90-day rule. If it's in the state, if your aircraft is in a state, or your new aircraft, your travel plans have you going in the state for 30, 60, or 90 days, you can trigger the aircraft registration fee. Why is it such a big deal? It's $5, $10. Well, in the case of Virginia, it's $5. But in order to register the aircraft in Virginia, you have to prove that you paid the use tax or sales tax in another state, and Virginia has no exemptions. So common carrier doesn't matter, sale for resale doesn't matter. You have to have paid the tax in another state. There's no allocation among the states. So you're going to, they don't say, oh, you paid this much here. No, they're going to say, you're in our state, you're going to owe all of it to our state as well. So you've got to be real careful. They don't allocate that registration fee among the states. It's either all or nothing. Generally not applicable to the airlines and to commercial aircraft. And I always think it's a good thing to pay a registration fee. Kind of like paying a registration fee on your car, you get a little sticker. You get the cute little sticker to put on your beautiful multi-million-dollar asset. But when the departments of revenue are sending out their worker bees out there at the airports to take down tail numbers, they'll see a registration on an aircraft and they'll typically just skip that one because it does show that it is registered in another state. Blind faith, good faith, but I'm not going to argue with them. So here you need to understand where the aircraft is primarily hangared or where it goes on a frequent basis. And there's a risk in any state in which the aircraft goes in. I did have a case here in Arizona where I got the call, and they said the state of Arizona sent me this nasty note saying that I owe a tax in Arizona because, my aircraft's in Arizona. And I said, great. How often has your aircraft been in Arizona? He goes, 3 days. 3 days every year? He goes, about 3 days every year. I come in for a particular event, so it's here 3 days every year. Great. You have the flight log. I said, so they're asking for your flight logs. They go, do I have to send them? Yes, you do. I said, I'm going to tell you right now that you don't owe a tax to Arizona, but you do need to send them. If they come and ask you for this, you have to send them everything they ask for. And so we got that all cleared up and everything. Found out the reason that they got that letter was that the airport, this little airport, making sure they got all their AIP funding, right, overcounted the aircraft at the airport. Basically reported that aircraft as a based aircraft at the airport in Arizona. So I don't know what happened after we proved the aircraft was not based in Arizona. Not my problem at that point, but the guy did not owe taxes to Arizona. So here are the states with registration fees, and you're looking at 1, 2, 3, 4. You're at 24 states that have a aircraft registration fee. If you go to any of those states on a frequent basis, take a look at it. Personal property taxes. This is computed based on the aircraft value, generally. I always have to say generally because nothing's absolute in this world. But in order for this tax to be due, the aircraft must have situs in the state, meaning it must have been in the state. It came into the state, again, on a frequent basis. Remember, 30, 60, 90-day rules. I always say that California has a 30-day rule for personal property tax. If that aircraft is in the state for 30 days, you're going to owe 1/12 of the California property tax to the state of California. Just write the check. You know you're going to owe it. If multiple situs, then allocation may apply. You can owe property tax in California and owe property tax in Nevada, and you'll probably end up paying about 102% of the aircraft, because you could be in both states in the same day, so it gets double counted. Generally higher than aircraft registration fees because it is based on the value of the aircraft. It is typically not dedicated to an aviation aircraft registration fee, is to be used for aviation projects. My point is, living here in Arizona, I know the rules, and my thing is that it may not be dedicated, but there's money collected going into the county coffers. And for ARP funding, you've got the federal, the state, and the local areas providing funding for airport development. So look at that as well. Make sure you use the money for airports. There is risk in any state as a property tax, just to any period of time. I mean, most people can argue if it's not there for 30 days, it's not going to owe property tax. But at 30 days, they really get a little persnickety. We know that California's that way. We know Nevada's that way. We know that Arizona has a 30-day rule, a 90-day rule for their transaction privilege tax, which is similar to a property tax. So where the aircraft's hangared, but where it goes on a frequent basis. If you're one of those lucky people, the owner's one of these lucky people that gets to fly all around the Southwest, we've got several property tax states down here. So look at that. Here are the property tax states. Not as many. What do we got? 1, 2, 3, 5, 10, 15, 17 states with property taxes. And we've got 4 very aggressive. I mentioned California. Every time I see Tom Alston on the screen right here, I know California. But Kentucky, man, they are very, very aggressive. Nevada is very aggressive. Nevada's personal property tax is almost the same and almost applied the same as California. Missouri, anybody who goes into Missouri and the aircraft weighs 3,000 pounds or more, you will owe a property tax to Missouri. And the property tax in Missouri is based on the amount of time you spend over Missouri getting to your airport. So you fly into Missouri, it takes you 100 miles to get to your airport, to Springfield, then you leave and you go back out. Those 200 miles are taxable. You'll be subject to tax on those 200 miles. You have to land in Missouri. Just flying over Missouri doesn't trigger the tax, but the time spent over Missouri to land in your airport, at the airport you want, will trigger the tax. So planning on which way you're going to get into Missouri. Maybe you should take a shorter distance, maybe just land in Illinois and drive over to Missouri and don't taint the aircraft. Never know. But those are the 4 most aggressive states. If anybody knows of another aggressive state, please let me know. I like to keep people aware and informed. So other similar fees and taxes other than what we just talked about, I mentioned the Arizona license tax here. And we call it the 91 to 209 day rule, greater than 209. Anywhere up to 90 days, you are not subject to license tax in Arizona if you're not a resident. But anything over 90 days, then you are now subject to a license tax of 0.1%. It's not that big. But if you fail to do it and you get a letter from the state, they go back 10 years. So $100,000 times 10, that's a little bit much to pay in 1 year. So keep an eye on that. Indiana, Maine, they have aircraft excise taxes where it's similar to, in Indiana, it's similar to a registration fee based on age and weight of aircraft. And in Maine, it's more similar to a property tax where they use a millage rate and age. I've already mentioned New Hampshire with their operating fee. And Utah has a uniform fee that they keep on changing. They have a uniform fee, and then they also have an aircraft registration fee, and the aircraft registration fee is a significant dollar amount, but the uniform fee is only $25. Significant. I figure anything more than $5,000 a year is significant. My favorite topic, gotcha states. A gotcha state is a state that will tax non-resident aircraft even though the aircraft has been properly registered and the owner is paying all the appropriate taxes to the state in which it's predominantly hangared. Gotcha state. Arizona, gotcha state. They're going to tax you if you come here 90 days. Virginia, and I know my good friend Randy Burdett, who's now retired from the Commonwealth of Virginia's Department of Aviation, he says, would you quit calling my state a gotcha state? I said, well, it is. I said, if I'm in Virginia for 60 days during any 12-month period, that means it's a floating 12 months. It's not a calendar year. It's not June to June or July to July. It's a moving 12 months. That means if your aircraft is on average in the state for more than 2 days a month, you're going to trigger the aircraft registration fee and the 2% Virginia use tax on the purchase price or the value of that aircraft. Going into to a state on a regular basis can trigger a use tax, registration fees, license taxes, personal property taxes. Understand that when we say day, we don't mean day. We mean date. If it was in that state on that date, that counts as one. If it was in that state 5 times on that date, that's 1. But if it went into the state on Monday at 11 o'clock at night and left at 2 a.m. the next day, that's 2 dates. So how many dates has the aircraft been in that state? Again, that 30, 60, 90-day rule. I think by the end of this presentation, you'll get that 30, 60, 90 days. Arizona is a gotcha state. California, Florida. Oh, my goodness gracious. How many people from Michigan, Indiana, and Illinois can buy an aircraft in November and then go to Florida for the rest of the year and for the first 4 months of the next year, and I have to tell them that you can't take your airplane there? Because if you put it in Florida for more than 21 days or more, you're going to owe the Florida tax where you avoided the tax in Michigan and Illinois because you put it on a common carrier exemption. Florida doesn't have a common carrier exemption. So I can only advise you. I can't tell you what to do. So, keep it out of the state of Florida for the first 6 months. Go charter an airplane. Put it into maintenance. Have all the work done. Get the ADS-B done at this point, but don't bring it to Florida. Illinois is a gotcha state. The only exemption in Illinois is the rolling stock exemption. Iowa, crazy enough, has a 30-day rule for aircraft registration. That's a $5,000 fee if you're there more than 30 days, not consecutive. Kentucky, commercial aircraft, kind of like Washington State. Washington State's another gotcha state. Commercial aircraft coming into the state can be assessed personal property based on the amount of time in the state. 91 aircraft are different, but commercial 135 aircraft, you can trigger the tax in Kentucky. Missouri, I've covered that. Idaho, very strict, very, very strict, really adhering to that 90-day rule. Minnesota, getting much stricter because they changed the rules around. Virginia, I've already covered, and Washington as well. So those are your gotcha states. Those are some of the gotcha states. Again, these are some of the states that are most aggressive. So states are sending out letters. When you get a letter from the Department of Revenue, if you get a letter from the IRS, please do not ignore them. It's like ignoring Mother Nature. They don't like it. Do not ignore the letter. The first thing you should do, honest, is call somebody and immediately. Call them. Just develop a strategy right then and there. Number 2, if we can't gather that information in the next 7 days or 5 business days, I go just ask for an extension, that you need an additional 30 days or 60 days to gather all the information that they're asking for. But do not ignore the letter. The more you ignore them, the more ticked off they get, the harder it is to reason with them. It's kind of like a child. Okay? So before you buy your aircraft, before you operate the aircraft, start your tax planning strategies. When you do your tax planning strategies should start the same time as how am I going to own this airplane? What am I going to use the airplane for? Oh, my favorite one is I'm buying this aircraft because I'm going to get the depreciation. I'm going to write off 100% of this depreciation. great, but you're putting it on somebody's 135 certificate 100% of the time. That creates passive activity. Maybe not so much writing off 100% of the aircraft. What's your risk? What states do you have risk in? Where's this aircraft going to be delivered? Where's it going to be hangared? Where's it going to operate? Look at all those items before you decide on where you're going to buy the aircraft or how to buy it. Where's the exposure? Remember, it's hide to heart an airplane. Aircraft are beautiful. I don't care if it's a 182 or G650. They're all fascinating. They're all pretty. And the Departments of Revenue love looking at airplanes. So very hard to hide the airplane. Pay taxes somewhere. Claim a state. It sounds too good to be true. It really probably is. My next slides are just, I guess, Tom, did they get a copy of the slides? Okay. You'll get a copy of the slides. What I've done here in the last few slides, because I'd like to leave some time here for questions, are where there's been some activity. You can see that Arizona changed their 135 exemption, or created a 135 exemption. Arkansas now has 3 flyaway rules. California reduced their tax by 0.25%. Indiana raised their fuel tax by 100%. But it's dedicated, so I'm not too worried about it. North Dakota, they changed their aircraft registration fee schedules. Oklahoma increased their registration fees by 50%. South Carolina changed their maximum sales tax from $300 to $500. I mean, don't have a heart attack. Virginia passed in 2017, but was effective in 2018, a maintenance exemption until 2022. And Oklahoma has, I said this already, is a common carrier, and West Virginia has a maintenance exemption for fractional ownership aircraft. Must have been too close to Ohio. And there's some other ones. Utah has a couple of bills going on, but we're still kind of tracking it because it's getting the governor veto power. They didn't veto, so it automatically becomes law, but some states are 90 days, some days are 120 days, and haven't nailed that down yet. So okay. Does property tax apply in states where only maintenance is being done? Typically, no. Typically, no. It's going to go into the state. It's going to go into maintenance. In fact, in most states, the time in maintenance, the days in maintenance, does not trigger the 30, 60, 90-day rules because they're in there for maintenance, so they're not hangared in that state. Property tax, use taxes, registration fees typically are not due. Here in Arizona, we've got a Bombardier Service Center, and we have a maintenance registration, and so if it's going to be in maintenance for a long time, it's best to fill out the form and pay the $20 and keep it here. It's also $20 to store your aircraft in Arizona, too. We had a lot of stored aircraft here after 2008, 9. Any other questions? Oh, come on, Dave Marshall. Hi, Shay.
Just so everybody knows what's going on, is we're using our cell phones, Nell and I, so that she can hear me, because for some reason she can't hear me through the normal thing. So here we are. That's why Shay called you, Nell. Just leave it open, and then if I have anything to say, you can hear what I'm saying to everyone else.
Okay, great. Thank you.
So please, if you have any questions, I know Nell went over quite a bit of stuff. Each one of these states, she could probably do a deep dive for you, but the purpose of this webinar today was to make you aware that it's a state issue, state by state issue. It's not a federal issue, so every state has their own rules. So that's why we're doing it kind of in a general, kind of a speed dating attitude towards things. If you have any greater questions for Nell, you've got her contact information. Nell, we have your permission to send the PowerPoint out to people?
Absolutely, absolutely. And I have a question right here, or comment. I'm pretty sure it might have been somebody from New England, Lee Road. Yes, New Hampshire did just recently pass a new law with a major restructure of the registration fees because the registration fees were taking them out of competition with all the states that don't even tax aircraft and have no registration fees. So people were, I don't know if they were fleeing New Hampshire, but they definitely were concerned with the high registration fees in New Hampshire. So thank you for whoever put that up there.
I want to again say that this is your webinar. You have an opportunity to talk directly to the country's foremost expert on sales taxes and use taxes on a state-by-state basis. She's here. She's giving your time, her time to you for free. So take advantage of it and ask her questions while she's here. Because she's always busy. I mean, she's my buddy, but sometimes it takes a week to get her to call me back. So I'm just telling you, she's here. She's doing this for you. Ask her plenty of questions.
If anybody hears anything, that's going on out there, I'd be happy. I'd love to get it. I do track all 50 states, and I do read all the legislation. New Mexico does have a use tax. Hold on a minute. Watch this. I have the state tax guide, and there is a 135 exemption in New Mexico, and there is a sale for resale exemption in New Mexico. So either way, if it's put on 135, and let me see, has to be primarily used in 135, and you could be exempt from the use tax. Otherwise, if it's not going to be on 135 and you just want to spread out the use tax, you can use the sale for resale exemption, purchasing it into an LLC, tax ID number in advance, and lease it to the operating company and pay use tax on a fair market value lease rate. There is a registration fee in New Mexico, but it's de minimis. It's like about $250 for a registration fee.
Any other questions?
That's based on the weight of the aircraft, like a penny a pound, a penny to 2 pennies a pound.
Any other questions? She's here for you for another, 10, 15 minutes. She's dedicated her time to you.
Yeah, Justin. Don't call me. Dave Marshall, don't call me after this is over. Just kidding. Call me anytime.
Frank, DJ, Gary, Heather, Justin, Kevin, Lee.
Bill.
Opportunity. Come on.
Bill.
Well, it looks like nobody else. You've overwhelmed us. You've given us too much great information, so now we're complete tax experts in every state. So, Nel, I want to thank you again for your time. And if anything hot comes up, let me know, and I'll make another webinar available to you. Anytime something comes up.
I have another topic.
There you go.
I wanted to bring this up because it's something that's kind of hit the fan. I went to eBay this year for the first time. I don't need the phone. I went to eBay for the first time in about 7 or 8 years and was introduced to a lot of law firms and consulting firms and dealers and brokers. And I know we do it here in the United States, but a lot of the internationals prefer to have their acquisitions occur here in the United States, mainly I think because it goes into maintenance. But what I was getting with was, I'm going to say the word back-to-back. I'm not involved in the ethical issues surrounding doing a back-to-back transaction in a state. That was not my concern. I know there's ethics about that, and NARA, the National Aircraft Resale Association, is very hot on that, and I don't need to go into details on the ethical standards that go in there. That's not my point. My point is the state tax. So I'm going to have seller 1 selling the aircraft to buyer 1. Buyer 1's going to own it for like 5 minutes, and now they're going to become seller 2 and sell it to buyer 2. Can that first buyer, the second seller, actually buy that aircraft without paying tax in the state? The Flyway Rule doesn't apply, so the seller sold it to them. They're not going to remove it from the state. They're going to hold on to it for 5 minutes before they sell it. So it's going to stay right there. Then the second buyer can use the flyaway rule. So I'm not worried about the second buyer, and I'm not worried about the first seller. I'm worried about that guy in the middle. And I was doing research in Missouri and Illinois. It's not clear that you can do a back-to-back in Illinois or Missouri until you pick up the phone and spend about 4 or 5 hours talking to the right people and getting the right answers. So I'm not going to tell you what the result was. But at any rate, so be careful of back-to-back transactions. If you're going to be involved in a back-to-back, pick a state that doesn't even tax airplanes, okay? Just right off the bat, just pick a state that doesn't tax airplanes. You know, Connecticut, New Hampshire, Oregon, pick a state that just doesn't tax it. Then there's really no question. But in this case, and this was international, the aircraft was in maintenance. And this was, okay, it's funny because I get this phone call right after eBay. No, we need it now. We have to have it done by the end of the week. Okay, great. The aircraft's in Missouri, it's in maintenance, it's torn down, it can't be removed. We've got to do the back-to-back in Missouri. Great. Spent 4 or 5 hours, said, okay, you can do the back-to-back in Missouri. And wrote it up. It was about 2 or 3 pages of a write-up with a bunch of information to back it up. Great. Sent it to him, got up the next morning, hadn't heard from him. I said, how'd you like the risk report? Are we good? They go, well, actually, the aircraft's not in maintenance in Missouri. It's in Illinois. And I went, really? So they said, can you do that? I said, I can, but I'm going to have to charge you a little bit more because I'm having to do the same job all over again. So we agreed on what I was going to bill and went into Illinois. And again, it took, I was on the phone for a couple of hours on and off getting the right information because even the state of the Departments of Revenue aren't 100% sure. So Missouri and Illinois, you can do it, but it's tricky. But I just thought it was funny that, oh, it's in Missouri, no, it's in Illinois. So, you know, very confusing. So back-to-backs, if you're doing a back-to-back and the state is not a non-tax state, then you need to look at what's the impact on buyer 1, seller 2. So those are my 2 cents on back-to-back. Taxes on a back-to-back. Anybody deal with any of those things? Anybody get caught in any of those kind of things with state taxes? This type of consulting for people are for people that are low risk, like me. I'll never be a millionaire. You know, low risk people. They do not want any risk. There's enough risks in life without being risky on this. Okay.
Nel?
Oh, I'm here.
Is the reason you didn't want to ask or tell us how it worked out on the back-to-back was because how you feel about the ethicalness of the back-to-back transactions?
Pretty much. You know, the problem with the ethics is the disclosure. You know, does the seller know, you know, is there a big markup in the middle? So is the seller selling the aircraft for $6 million? The buyer 1 is paying $6 million, and then they're selling it to buyer 2 for $7 million and keeping that additional $1 million. Do they know that? So it's the ethics of do they know this? Oh, yeah. So I mean that's the ethics of, you know, does the original buyer and the ultimate purchaser understand that, you know, what's going on in the middle? So if you disclose what's going on in the middle, then it's ethical. If you don't disclose what's going on in the middle.
You already answered my second question that I was going to ask you. Under what circumstances do you consider a back-to-back be okay? But I think that you've already answered that. Yeah,
as long as the buyer and the seller, the seller, at the first seller and the second buyer understand what happened in the middle, then it's ethical. If it's disclosed.
Okay, great. I think we've arrived at the end of today's presentation. I thank you for everyone for participating. Nel has given us permission to make available to you her PowerPoint, and Shay just told me she'll send it today. And then we will also have the video of this presentation up on our website pretty soon. So thanks again, Nel, for
You're
being
very welcome.
part of our deal. And again, anytime you hear something that's critical of nature and you think you want to get it out across the country, just let us know and we'll help you be that vehicle.
Thank you so much, Tom.
That draws us to the end of today. Thank you for
Everybody have a
attending.
great day. Thank you. Thank you so much.